Hello and welcome to today's discussion using relationship intelligence to catch more unicorns. My name is Paul Ross and I'm head of marketing here at Affinity. And I'm really pleased to welcome you to this discussion with a number of incredible panelists. And we're really going to be focusing in on the results of a report that we published recently at Affinity related to what's been happening with companies that have been become unicorns in the last 5 years. I am really excited about the panel that joins me for this discussion today. Some incredible people. We're going to be discussing very in-depth topics. First of all is Ray Zhou. Ray is co-founder and CEO of Affinity. He founded Affinity along with Shubham Goel, who we met at Stanford, to build a relationship intelligence platform now used by well over 1,900 deal-making organizations across venture capital, investment banking, and consulting. I'm also really honored to be joined today by Harry Stebbings. Harry is the founder of 20-Minute VC, the world's largest independent venture capital podcast with over 100,000 listeners, with some incredible guests from Cuban to venture capitalists from Excel, Kleiner, White, Combinator, and Benchmark, to name just a few. Harry has an incredible audience and also is involved with a number of other activities like TechCrunch, Sastra, and a number of other podcasts as well. So really glad to have Harry with us today. And finally, joined by Ian. Ian is, like myself and Harry, from the UK and started his career or adult life as a mechanical engineering student here at the University of California in Berkeley. And then built his career as being a strategy consultant initially, and then transitioned to the world of venture capital, where he designed and launched a $2.5 billion fund of funds and led their investment strategy. So he's now back here in the Bay Area and works at Pear VC, one of the early investors in Affinity. And I'm really happy to have him as part of our panel this morning. Welcome, gentlemen.
Let's do this. This will be fun.
Thanks for coming, guys.
Thank you. So what we're going to do today is we're going to have a panel discussion around a number of the trends that we're seeing in terms of venture capital investing, specifically driven from a report that we published fairly recently, where we looked at data from the Affinity platform in the context of almost 1,000 unicorns or organizations that have become unicorns between 2017 and 2021. Like the sheer number of these is amazing, how many companies are reaching unicorn status, and we all know that's accelerating. We've also taken a look at, in terms of valuation, the top 100, and then done some comparisons in terms of those two groups to see if there's anything interesting in terms of the core elements. The way that we've done that is we've used, our platform, where we have a set of data that our deal makers, venture capitalists, investment bankers, et cetera, use on a daily basis to look at companies' funding information, the investors, their valuation, so et cetera. We brought that together in this report to kind of look across these almost 1,000 organizations to see what trends we could out there, as well as things like gender of founders, et cetera. And we also flipped that around and looked at the firms that were investing in those unicorns during that period. What could we glean from them in terms of trends, in terms of their investment strategies, in terms of who they actually were as well. And then finally, we took somewhat of the secret sauce from the Affinity platform, which is the relationship intelligence data. So how much engagement were VCs having with these unicorn firms, and then kind of benchmarking that across what we were doing in terms of all those founders and unicorn organizations. So a few kind of early data points here. One of the most interesting things that, for me, that as we looked at this, and this is a trend that we've seen kind of evolve over the last couple of years, is that more and more unicorns are staying private for longer. On the right-hand side here, you can kind of see the distribution of those, 925 firms that have become unicorns between 2017 and 2021, what stage they were at today. And what you can see here is only about 20% have had a kind of a full outcome, as it were. Either going through IPO or going through some kind of equity event, major equity event like private equity. Most of these are staying private longer. Part of this, I think, is driven by the fact that we're seeing more and more earlier stages of companies becoming unicorns because of the valuations are going. And then somewhat that maybe devalues the idea of unicorns being that exit point. But really what it is essentially becoming is more and more of an indication of success and longevity as well. Harry, maybe if I start with you, what's your perspective on what you're seeing in your portfolio in terms of this, more and more of these unicorns staying private or earlier stage companies becoming kind of that valuation of the $1 billion plus?
Paul, you know me, I'm blunt, I'm direct. Why on earth would you go public? I mean, seriously, with the proliferation of late stage capital and the massive rise in increase in use of secondaries, founders can get liquidity in later stage rounds. Pricing is incredibly elastic from a lot of the late stage players who've entered, so they get great pricing, they get secondary ability, they don't have the scrutiny from the public markets, they don't have to do a roadshow. An IPO is a huge commitment. It can be very significant in terms of time and exposure. Why would you bother if you can actually just delay it and have another round of funding at a very high price internally and actually not have that scrutiny put on you before maybe you're ready? I absolutely, I think IPOs are great and you will eventually, but why are we seeing them delayed? Because there's so much late stage cash that's price insensitive and they can take secondaries, and why would you take that responsibility on early? So I don't think it's like a good thing or a bad thing necessarily, but I think that's definitely why.
Yeah, I think I would agree with you. Ian, in terms of your portfolios and maybe even some of the previous funds that you work with, I wouldn't imagine you would have so much of a different perspective to Harry on this, but maybe what are you seeing within those organizations and the decisions that they're making?
Yeah, I mean, only building on what Harry said before, I think this point around scrutiny from the public markets and try and avoid that as long as possible. So these founder CEOs can pursue their visions as clearly as possible. They know what they want to do, and they don't feel like they want to be held by the bounds of the public markets in aspiring for those visions. I mean, given the macroeconomic conditions right now, low interest rate environment, so much capital is flooded into venture capital because it's more attractive in terms of return. So there's just much more capital out there to stay private for longer.
Makes total sense, yeah.
Also, Paul, sorry, just on this one, you know, Box does like, you know, whatever it is, north of 700 million in revenue, and it's like a $3.5–4 billion market cap company. I mean, you know, Box is a great company. Like, it is. Why would you go public when you can get a 10 billion valuation from private markets? It just makes no sense. Sorry, fun data point.
No, I think it's a great data point. I don't know, Ray, bringing this to you, like as a founder, what's your perspective on this?
Yeah, it's interesting. Yeah, so I guess I was going to say, as a founder, I feel like I get to either validate or invalidate a lot of what Harry is saying here, and I think it's super valid. I think the right way to think about this is to break it down into the first principles. Like, there is a bit of a culture, I think, often in the technology world that exalts the event of going public. But when you really decompose it down to the first principles, like, what does it actually offer, right? It's got pros and cons. On one hand, it's a fundraising event. It's literally called an initial public offering, right? You're trying to raise capital. And on the other hand, it creates liquidity. And when you think about it, like from that first principles perspective, like, we're living in a world where there's more funding activity that's happened like in the last 5 years combined than like any of us could have ever imagined. And so capital for its own sake to really fuel the next phase of growth, the next set of companies' ambitions, that's not the main reason, I think, right? Because it's so abundant. And so yeah, like, all these things considered, I think it makes sense logically. It's not that founder values or the values of the decision makers at companies that are deciding when makes sense for an IPO versus not are changing. They've always sort of held constants. The landscape itself has changed, and that's been a function of this influx of capital and all these other factors that we're seeing that Harry and Ian talked about. So
I like the fact that you stayed away from the taking money off the table and getting yourself some liquidity and dollars at the end there, that Ray. But I think that's also like clearly one of the things that Harry was highlighting is the so much late stage, and I think that's reflective in this chart in terms of the amount of value that are going into valuation. Excuse me, they're going into that class of unicorns. It's so much late stage stuff that's really helping. And as a founder as well, like this is a 7-year journey on average for the companies that get to this stage. We all know that like the likelihood of getting from seed to late stage, around G, whatever the right kind of measurement of that true late stage environment is a long way, but 7 years is the average in terms of this now. Ray, wonder what your thoughts are in terms of as a founder building towards that. I know that you've been at this for quite a while, and this seems like core principle of it takes time.
I feel like compared. Actually, recently I was on. I think Pear Ventures was launching their recent sort of accelerator program with the newest class, and I was speaking to the group and felt like an old person, an old man compared to other companies that are there. But no, for sure. I mean, I think it takes a lot of tenacity, right? I mean, one of the things I've learned really, I guess, building Affinity is that, there really is, I mean, barring very, very few like highly exceptional, occasions, there isn't really such a notion as like just like single night, like overnight success. It really is a grind. And I think, at least coming from someone who started Affinity right out of college, like when I look back at it, before starting Affinity, everything was kind of laid out in these like essentially these like 4-year chunks. It was like, college is 4 years, high school before that is 4 years. They're always punctuated by these like halcyon periods. You had summer breaks and everything in between. Like you expect a bit of a reset. And one of the things, at least for me, when we started the company, was at some point realizing like there's a glamour of like, hey, we're building something, we're starting something from scratch that kind of hits you for the first maybe 3 to 6 months, and at some point you realize that you're staring into the abyss, basically. Like basically there are two scenarios. One scenario is the company doesn't work out, doesn't have a product market fit, and that's arguably the least painful scenario, actually. The good scenario is a scenario where things actually work out, and you realize you're basically building this thing for so many years to get it to the revenue scale, to get it to the impact, to actually achieve the vision of the company. And so, I think it was a bit jarring at some point to realize like, wow, like we're kind of staring down, we're gonna have to keep growing and keep building, and that's the path that we've chosen. But I think that moment happened for me, like many years ago. So it's something that I haven't really looked back at since.
So I don't want to go against my boss, obviously, with Ray, but I don't know, Harry, I think the other thing we're seeing though is there's a lot more companies getting incredibly high valuations very early. There's
my
perspective on that that's worth looking at.
Yeah, mine is like, normally it's like 2-3 years in now for the ones that are taking off respectfully. I would never question your data, obviously, but I'm like 7 years. Oof, no. It's like,
well, I think what you're seeing there, I think it's a good point, Harry. I think it's the difference is the time period that we're talking about. Like the acceleration has really happened in the last 3 years.
100%, and it's I call it the foie growing of startups. So I apologize for any vegans here, but what we have is the VCs basically force feeding so much cash into early stage startups so early, inflating the price to unicorn status. And what's so worrying for me about that is it's fundamentally distorting the execution plans of so many of these companies pre-playbook creation. So if you don't have a sales playbook or a marketing playbook, and someone puts 50 to 100 million on the table at $1 billion, you think, great, I'm going to hire 30 reps in sales and marketing. You don't have a playbook. And when you don't have a playbook, you're not going to be successful. And when you're not successful, you're going to have churn. And when you churn, you're going to have a massive reduction in culture. And when you have a massive reduction in culture combined with the failed playbook and the failed track, it's going to be bad news. So the foie growing of startups, I think, is what's causing this acceleration in time to IPO. And I think it's distorting the execution plans, which, makes a boomer like me very nervous, Paul.
A boomer like you, Harry. I love it. Ian, I was going to ask you a question related to that, which was like, as an advisor to so many of these startups, especially early stage, how do you think about what Harry was saying in terms of balancing that, like all these incredible opportunities for funding with getting it right first and being able to, do the right thing for you as a founder and as an organization?
Yeah, I wholly agree with Harry. So our main advice to founders is they should be focusing on the main inflection points for their company for value creation. And it's about value creation, not valuations. And we see these inflection points coming first when you demonstrate customer love. So you found people that really love your product through engagement, retention. Secondly, you found that scalable go-to-market playbook that Harry was speaking about. So you have a sales team that can scale many times over using that same playbook across geographies or segments. And then thirdly, you've got the flywheel going. So you're compounding defensibility and your product and your go-to-market strategies are getting stronger and stronger. So yes, valuations are going up, but unless you get those three things in place, you're not creating value. So being able to raise capital is only an enabler to those aspects. When we work with our companies, we split down their plans into an operational plan, and the first line is the North Star metric. The the bottom line is the finances of the company. So yeah, we really think of it through value creation, through inflection points, rather than the valuations that they're able to achieve.
Yeah,
that's key. Ray.
Yeah, maybe going back to something that you said earlier, Harry, as well. I think one thing that's interesting is like, I mean, I guess there's a difference between like there are unicorns and there's successful unicorns, right? I don't think those things are necessarily the same, especially at the earlier stages. I think there is a lot of the valuations that we're seeing that are driven by essentially the narrative of the company, right? And maybe this, Ian, Harry, I'm kind of curious to hear your guys' thoughts on this, but maybe ironically enough, like the absence of all of this data. I mean, you mentioned Box earlier, Harry. There's so much like prior data in terms of that's actually public now in terms of like how their performance and growth has been over time. But in the absence of data, there's sort of more room to dream essentially as an investor to say, well, I'm looking for a massive return. I can totally see the narrative of this company panning out, as opposed to when you've been generating revenue or trying to generate revenue for X number of years, that tells a very different type of growth story. So actually, I'm curious to hear about what do you guys think about that? In terms of sort of the trade-off between like narrative and the metrics, and which of the two is driving a lot of the venture fundraising today?
I think it's, sorry, this one really upsets me. It's very sad that we've lost the art of storytelling today. I think founders bluntly, and I think it's partly due to the proliferation of capital, but the need to tell a great story, the need to really create that narrative, to bring you in, whether you're a customer, an investor, an employee, it's kind of just, it's been a little bit lost because I think round compression is real and there's so much cash. And so the need to do that has changed. And I think it's not one or the other. It's like, everything with art and science. The truth is it's probably a blend of the two. You need the metrics or you need early signs, and then you need the narrative too. I think the narrative is always crucial. But, I think you need both. So yeah, I'd say that. Ian, what about you?
Yeah, sure. When we work with preparing our companies to get to Series A, we spend a lot of time thinking about the big company story. And big company story is kind of the vision, but it's really grounded in evidence behind how do you aspire to that vision. We break it down typically into kind of what do we need to believe is true for this to become a really big company in the future, and then substantiate that with evidence below it. I think there has been a tendency more and more now for not to need the evidence and just need the story. So yeah, I definitely see that as a problem. Any founder should be mindful, though, they're laying the foundation of a big company. They're only doing this to build a big company, and the capital enables them to do it. But at the end of the day, the narrative helps them get customers, helps them hire, helps them raise capital. But really, the fundamentals have to be in place to build that big company.
Kind of interesting that you guys are picking up both sides of this as a problem / something that we need to keep focused on, both on the actual fundamentals and also the storytelling. But it doesn't feel like there's a lot of pressure on certain founders, certain startups to be able to do that, given the sheer amount of capital available. So I want to flip us to a different topic now, which is when we start off, we looked at the companies that become unicorns in that first section. And now, like flipping this over to what the investors are doing, that are investing in those companies that become unicorn. So when we look across all of the VCs on our platform, we're now probably upwards of 1,600 venture capitals across the world using Affinity. If you look back at the data for 2019 and now for 2021, which only 2 years difference, there's about 60% increase in the number of deals being tracked on the platform per firm. So that means on average in 2019 there was about 4,000 deals being tracked over that full year. That means they're entered into the CRM, as it were. They're moved through stages. They're in deal lists, etc. Compare that with 2021, we're up over 6,300. That's a huge difference in volume and effort. And I'd be interested in maybe starting with Ian on this, which is like, how do you see that as a venture capitalist, like your team as a whole, being able to deal with the increased volume of opportunity and increased volume of deals that you're having to get engaged with, while actually still doing the due diligence, which is clearly a core part of your venture strategy?
Yeah, it's a really good question. And I think this increase in number of deals per investor, let's say, has been driven principally by two things. One is just the number of exceptional founders out there who are trying to build category defining companies. So I think overall the number of really strong founders is increasing, but that's more gradual than this steep increase over these 2 years. And I think the steep increase is very much driven by, yes, market sentiment, the kind of the FOMO, the aggression to win more investments and kind of be there before anyone else, but also just our efficiency evaluating companies. So now with more data signals and relationship intelligence like Affinity means that we can just see more companies more efficiently and also better allocate our attention to the best ones. So now when we see 1,000 companies, we're better at honing in on the 100 ones that seem good and then figuring out which 10 to spend all our attention on. So we might be seeing many more companies at the top of the funnel, but I would say the ones we spend our real deep attention on is staying relatively similar. So we're trying not to reduce the time for our diligence process, I would say. Maybe we do it in a few days and really focus a bit more now on individual companies rather than spreading it out over a couple of weeks. But yeah, overall, I would say a lot of this is driven by the efficiency of the investment process, and there's no going back. Kind of, we're doing Zooms, not kind of long coffee chats now. We're analyzing data more efficiently. So yeah, there's no going back now. I really see this being a step change in the industry.
There's clearly a go ahead, Harry.
Yeah, there's a couple. I think for me, it's like, there's two types of investor predominantly in the future. There's Walmart and there's Chanel. If you're into high fashion, like us Europeans are. Walmart, this is high velocity, dollars out the door. You come in, you get your products, and you leave with a good price, decent experience. Or it's Chanel, very boutique, crafted, very carefully thought through in every way, much more kind of small and precious and thoughtful. And I think you have these two different types of investors that will really dominate in the future. I think the ones that will struggle will be the ones in the middle. And so I think when you think about like the increase in deal flow quality, it will separate between the two types. And then I also think, bluntly, what have we seen more than ever? And Ian will be able to obviously cite this, obviously coming from the LP world, compression of fundraising, like funding deployment timelines. And we are back in the day, it used to be 3-year deployment cycles. Now people are going through them in 9 months, 12 months. And so actually, yes, like deal flow is increasing, but deal cadence is increasing faster than ever. Actually, we've cut it by, 2/3. And so I think that's something that's super important. I think the really interesting thing with the, rate hikes that are coming and with the macro instability that I maybe we're bringing in like a massive one here, but like, with rate hikes coming, with the macro and what we think will happening, what's going to happen to deployment cycles then? How does it look then? That's what's really interesting for me. But yeah, I think we can't ignore that deal flow is increasing, but just deal cadences too. People are spending money quicker.
And you know what else is interesting? Speak.
Go ahead.
Maybe I think something you're alluding to there just now, Harry, is also, speaking of sort of the LP world, I think conventionally one of the things that we've seen is there's all these sort of players in the ecosystem that would be LPs or are LPs in sort of the PE and VC landscape that are now starting to get directly invested. You're seeing the rise of all these like really non-traditional investors. I mean, I remember when we were building Affinity, to be frank with you, 5 years ago or back in 2019, whatever the time scale you want to be, like the first time we talked to, say it's like, wow, we're having a lot of conversations with sovereign wealth funds, or like pension plans and or hedge funds, et cetera. Now crypto, right? Like there's all these players that non-traditionally would have been, really directly invested in this, general sort of in this zone, and they've really kind of brought to the field a new kind of game. Actually, it's interesting too. It's in terms of tactics, like the hedge funds turned PE investors, for example, right? Like I think many of those folks are the ones who sort of perpetuated this idea, the concept of this like ultra fast, like 1-day deal that's become incredibly attractive to a lot of founders, a lot of CEOs. Pushed a lot of sort of other investors out of the previous levels of comfortable like elongated diligence that we're all used to. So it's definitely been a lot of like the sand shifting there as well, I feel.
That's awesome. And I think as a founder, like and being on the operator side, I think we've seen the number of people involved in the top of funnel, like as Ian was describing on our side as well, go up, and you're trying to get to a better set of focused people that are getting further down, which also reflects, I think, what Harry, you were saying in terms of the separation of the models. And this was something we were discussing on Slack internally with the exec team yesterday, was this kind of separation of, or basically the firms in the middle are just going to die out and not be successful. You're either going deep and investing in the way that Pear, Ian has been talking about, or you're all about deployment of capital. I think that's important. One of the other things that was in the report that we saw was something that I don't think is that surprising to anyone, is that there's a small number of firms who are investing in a big chunk of these unicorns. Capital follows success. The same sort of people who are getting involved in later stage. I think there is some interesting things that are happening with VCs getting involved earlier potentially than they would have previously. And Ian, I'd be interested to hear from you, because Pear, I know, is involved with a lot of the earlier stage firms. Are you seeing more competition and more people who traditionally were in that middle stage, later stage, coming into your world?
Yeah, definitely. We're seeing what were typically kind of Series A or multi-stage investors coming down into pre-seed and seed more and more. I think time will tell in terms of kind of what the outcomes are for those companies. I really think at the earliest stage, that additional support from people who are ex-operators, people can help you build the company, really makes a big difference. And how the brands of those larger players will play out in the earlier stage as well. If they've made a promise but don't have capacity to help early stage companies, or maybe the attention and focus to help them, then we'll see how that brand plays out. But yeah, definitely have seen it. Some large, even kind of hedge fund players now seem to be coming into seed as well, which is driving valuations up, as we've seen in the market.
Yeah, that's very much in line with what we've been looking at. One of the most surprising things that I saw in the report, and I definitely love to hear everyone's opinion on this, which is when we looked at the number of startups that were reaching unicorn status in 2017 and compare that with 2021, the number of those firms or organizations that were actually founded by women had dropped. And given the huge focus that we've had on diversity of funding, more and more efforts being put into making this a much more diverse industry overall, acknowledging that there is a multi-year process to get from founding to unicorn status. But I'd love to get people's thoughts on this. Why do you think that this has happened? Does anyone have a specific kind of view on why this has actually gone down rather than up, given all the focus that's been on this?
I'm happy to kind of jump into it. I honestly don't. This one actually I found sad and confusing, to be quite honest. I can see in COVID, I thought diversity on both fund funding and company funding would generally go down, with generally people reverting back to existing networks in terms of kind of funding opportunities, which is wrong and sad in a lot of cases. But no, I'm interested to hear Ian's thoughts, because I was kind of sad and confused by this one.
Yeah, I was quite shocked as well. I think maybe there's a question of sample over time potentially. Maybe we should also look at a broader pool, so maybe like Series A's getting funded, so we can think more about what's changed over the past few years rather than backwards looking. But yeah, it is quite shocking. And overall, I would say my samples may be too small as well, personal sample of number of founders I see, but I do see more female founders now than maybe 2 or 3 years ago. But overall, I don't think it's changing fast enough. So there's definitely more we can do.
Yeah, it's interesting also because like one of the things you said earlier, Ian, I think, speaking of like why is, generally deal flow increasing is because there's, more great founders globally, right? And part of that, is we're living in a pandemic, like, now is the best time in the world to start a company. Like the world's globalized, there's amazing talent pools you can tap into from anywhere. You have people from all over the world that are going on and building great businesses with great tools and infrastructure. And so, it feels like, a lot of what it's going to take, over the coming years is to, tap into that globalization to really encourage and empower, women, other people from underrepresented groups to build companies, start companies. Like it's not some impossibility. Like everything in the world was built by people that are no different from any of us, right? And I know, for example, you guys at Pear, I think I saw recently, like launched initiatives like the female founder circles.
Yeah.
Which is pretty awesome. If you maybe want to share a little bit about that, but it's like
Yeah.
the world needs more innovation, more builders, especially in hard times, and it's kind of
I fully agree, Ray. And I think, building companies is really like it's a mindset and a philosophy that has spread globally. A lot more people kind of attune to that mindset now, but also need to be supported in taking the risk to do it as well by society and communities around them. So I think there's a couple of important points here in terms of like how we drive change in the industry. So I've read research saying that we're biased towards investing in people like us. I think everyone can kind of agree with that. So I think there's two things that we can do to improve that. One is better checking our cognitive bias. So kind of actually just looking back on the data in terms of the decisions we make and kind of the people that we give our attention to evaluate companies, and then increasing the diversity of VCs and the support around people when they're really early on in the journey. So when they're just figuring out whether they want to be venture capitalists or whether they want to be entrepreneurs, being given the opportunity to do that within kind of safe communities. So I'm fortunate to come from quite a diverse team at Pear. So one of our managing partners, Ma, is female. Also work with exceptional investors who are female. And we run a training program for VCs. So these are people who are generally students, maybe from 21 to say 26 years old, engineers and MBAs. And over the 100 people have gone through that training program. Over 50% have been female. And actually, most of the ones that seem to break into venture have been female as well. So very happy about that. And then, yes, we have a female founder circle, which is a community of people who are working on ideas or iterating on projects before they've taken the leap to build a company. And they come together to support each other in person and online. And I think these aspects are really important to drive change, both giving more females opportunity to become VCs, and then also providing more females opportunity to take a risk and start something.
Yeah, I would agree with all that. This conversation is really interesting, which is like, I think we were all shocked by how bad this trend was, but there's a lot of positivity around trying to make differences. And one thing you said there, Ian, was interesting to me and relevant to our world at Affinity is the data. It's like, how do you make sure you're tracking where you're making your investments, where you're understanding what behavior you're having? That's something that we've been thinking about a lot at Affinity, is like not only exposing the data to allow people to network and engage with the right people, in terms of if their investment strategies align with this, but also just then being able to track that behavior over time in your investments. So some really interesting stuff. So moving quickly on to our last section in terms of relationship intelligence, I think there's some interesting data here in terms of the amount of effort and work that people are putting in when they are getting into these kind of top funds or investing in unicorns, or organizations become unicorns. What we see in our data is that these people are a lot more engaged, a lot more pushing their network, 22% bigger network. They're doing more engagement, whether it's emails, whether they're tracking more deals, whether they're having more meetings. Not really surprising. Some of this is kind of like self-reinforcing. The people who are hustling and doing the things are the ones who are going to potentially get the right environments to invest in. But we definitely see that this is all increasing as well. So I don't think anything surprising here in terms of all the things we talked about. Harry, you mentioned, or Ian mentioned earlier, the pandemic change is fundamental. Like the pure volume of meetings that people are doing, et cetera, is just going up and up and up. As those of you on the venture side, like your perception of like, has your workload gone up? Are you more engaged? Or has this forced you to change your behavior more than maybe you expected it would?
It's a good question. Has the workload changed? Yes, the workload has gone up insanely. I mean, I've always loved these people that say, VCs, like, for retirement and to play golf. I'd love to see the golf course go. Like, really? I haven't played in a long time. I'd love a good round. It's like, absolutely. I mean, I do run a company on the side, but yeah, the other thing with investing is every single day you have the chance to change the lives of everyone in your firm. Because that next company could be DoorDash. It could be, you name whatever great company we want to name. And so every meeting, you have to bring the energy, you have to bring a renewed perspective, which means you just got to work harder. More deals, more opportunities, more great founders. Yeah, I think honestly, and I'm sure Ian would agree with me, we're just working harder. And I think that's it. We love it, but yeah, there's just more hours, and it's how it is.
Fully agree
Awesome.
on both.
Yeah.
I mean, absolutely love this. The volume has increased so much that I think over the past couple of years, the number of companies that we're seeing has doubled. It's maybe more efficient in terms of the people we reach, but yeah, the volume's insane, but we still love it.
So obviously there's a lot of increase in terms of activity, the pandemic, Zoom, all of those things. I was wondering in terms of not just the companies that you're looking at, but as the team grows, how are you dealing with that as an organization that you maintain what I know is a very specific kind of investment strategy and approach that you have with your potential investment companies?
Yeah, this solving this problem has become increasingly important as our team grows. So when I joined Pear, we were just 4 investors. Now we're 13 investors, and also have a growing platform team that works on recruiting, go-to-market, and product. So our mutual network has expanded hugely. This is really important for a couple of points. One is having this collaborative view together, so we can make sure that we're managing relationships effectively between us, and that comes through in terms of identifying kind of who the last stakeholder is, who the last person who's built that relationship. It might not have just come up in conversation. And then the other part is really leveraging each other's networks. So I've gone from a point where when we just had 4 investors and there was a founder that I was hoping to speak with, there was maybe a 20–30% chance that someone in my team had a connection with them. And now I would say it's like 80–90%, where we find that founder is just 1 degree of freedom away from us. I think that comes from obviously just the number of people we've added to the team, but also the diversity across the team. And yeah, that's really shocked me how much having that shared view between 20 people has allowed us to leverage a shared network to make sure that we're closer to individual founders.
That's awesome. A big problem to solve for. Ray, I think obviously you built Affinity to somewhat address the exact problem that Ian's explaining there and solving for it. What's your perspective about how we kind of evolve going forward in building out the relationships, the networks to actually support folks like Ian and his team in scaling?
Yeah, I mean, I think basically the technology has to evolve, with the way that relationship building is evolving and becoming increasingly important, right? So something we talked about a lot earlier is a big part of what's driving all this increased activity. The reason why Harry's unable to get out and play golf is because so much of relationship building has become digitized. There's just a lot more of it, and I think the numbers here clearly reflect that. They're essential when it comes to getting deals done. I like to think that we have a really good look into that because we kind of get this behind the scenes look into what it takes to power all these deals. And so, yeah, we're living in a world where, especially right now, you can't, as your team grows, you can't, get up and walk over to your colleague's desk and tap them and say, hey, what's the history of your relationship with this company that we talked to? Increasingly, it's critical for firms, I think, to have access to, incredible technology, relationship intelligence technology to help them answer those questions, make better decisions, triangulate better on founders and companies they're talking to. So it's going to play a really critical role.
And I think today we've spoken a lot about investments or deals and founders, but a really important point to note is that it's not just about finding these companies, it's about obviously helping them as well. And a lot of the help we do is through finding customers or helping them with early hires, and that's all driven by relationships as well. So when we think about leveraging our relationships, we're really thinking about it from a much broader sense than just finding investments.
100%. Yeah. I definitely agree with that, Ian. And I actually remember, I think Affinity's our own first 100 customers, so much of them came from the Pear network, funnily enough. When we were going on to raise early rounds of financing, it's all about relationships and the network being sort of the most valuable asset that an investor brings to the table. So couldn't agree more.
With that, I want to thank all of my panel, Ray, Harry, and Ian. Thank you so much for spending time with us today. This was a really insightful and fun conversation. Hoping that, Harry, you can get out and play golf soon.
Love it. Listen, thank you so much for having me and for letting me spout off for about half an hour. Ian and Ray, I'm really sorry, guys. I'd love to say I'm not normally like this, but I am. I just feel for my family.
You are. You are, Harry. You are, Harry. It's fine. We understand.
A pleasure.
Great.
Thank you.
Yeah. Thanks, guys. Yeah.